the Global Energy Leaders Podcast, episode 72.
Welcome to the Global Energy Leaders Podcast, powered by R Squared Global.
It's good to have you back on the Global Energy Leaders Podcast. As always, I'm your host, Ryan Ray, and today we bring on Alfonso Colombano, who is now a monthly contributor to the show, and will also be writing for globalenergymedia.com, so be sure to check out his posts there when they go live, which by the time this podcast comes out should be pretty close to the time that his posts on the website are there as well. And he will be on the show once a month, I think now, and we will link to all of his stuff in the show notes. We're going to talk today about the downstream industry and how the shale revolution has kind of changed the focus for companies like Exxon and others, to where maybe before the shale revolution, their business model was a little bit different, and now we're seeing this transition into companies who are looking at it going, okay, well, the downstream sector can make money for me, even though the production side can lose money. And so Alfonso has a lot of good insight on that part of the industry. Without further ado, here's my conversation with him just the other day. Well, Alfonso, it's good to have you back on the Global Energy Leaders Podcast. How are you doing today?
I'm doing great. The weather here in Houston is a little bit hot. It's usually hot, but I'm very grateful to be here and excited to be back on the podcast.
Yeah, it's no doubt. We're recording this on July 31st, and it's quite hot, to say the least, up here in a little bit further north of Texas than you are. But let's get into it. So today, and just for the listeners real quick, Alfonso is going to be a regular contributor to the podcast, and we have some other spots he's going to be contributing that you can find on globalenergymedia.com. We'll link to that information and put out some releases as that comes available. But today we're going to talk about downstream. And obviously, where we're recording at, you're hearing about the second quarter reports, the earnings reports, they're coming out. And obviously, downstream is playing a big part of that if you're actually able to go in there and read kind of what's going on. So let's just step back for a second. And Alfonso, kind of walk us through this process of pre-shale revolution. What was going on in the U.S. downstream sector, and then what has shifted since the shale revolution?
Yeah, that's a great question. So I'll give a little overview about downstream. So downstream is composed of three main, if I can call them, subsectors. So refining, which is the process of taking raw crude oil and other raw hydrocarbons and transforming them into valuable finished products, such as gasoline that we use for cars every day, diesel for trucks, jet fuel, and many, many other products. So, for example, gasoline is a blend of more than 200 hydrocarbons. It's a highly complex mixture of different molecules. The marketing sector, marketing and retail, if you can call it, or trading as well, delivers oil and gas products to the final customers, whether, that would be the retail stations that we pump gas at or fuel at around the United States and around the world. Then there's the petrochemical sector, which takes typically raw NGLs or byproducts of distilling crude oil and creates plastic products. So that's kind of like the overview. So what's happened in the U.S. downstream sector over the past, since the shale revolution started, has been fantastic. It's been a complete change of direction from what it used to be just 10, 15 years ago. I'll give a little bit of overview about in refining specifically. If a company had a refining asset in the U.S., first of all, they wanted to have it as close to the sea as possible. So, for example, if you see in the United States, we have a massive refining complex in the Gulf Coast, also refineries across along the East Coast of the United States. Why was that? Because a lot of the crude oil was imported. So you wanted to have strategic advantage in saying, I'm going to bring in crude oils imported from abroad. That way, if I'm closer to where the crude is coming in, I'll get an advantage. If you had some of the heritage refineries for what a lot of companies had in the Midwest or the center of the country, you were at a disadvantage. Why? Because you had to bring in crude oil and other products into the center of the country to produce the refined product. That was a complete disadvantage. What's happening today is the total opposite. You have massive increases in production in the center of the country, for example, the Permian Basin in West Texas, and those refinery assets, which many years ago, hey, who would like to buy a refinery in Midland? Nobody, right? That would have been a bad business decision. Today, you have companies like Tesoro buying out Western refinery. Why are they buying out Western refinery? Because they have a lot of assets they're linked to the Permian Basin indirectly or directly. The same with a company called Delek. They're buying out Allen USA because they have strategic assets in the Permian Basin. Before, you had to bring in crude from abroad. Today, you have locally sourced crude oils, which provide you an advantage. $1.50 per barrel advantage compared to imported crudes. So in the refining business, is highly margin business where each penny counts. So having that extra $1.50 of advantage of discount of your competitors really makes those assets in the center of the country stand out in and of themselves. It's been a complete turnaround. If you have a refinery in the Permian, you're doing fairly well. If you have a refinery maybe in the East Coast, long term the profitability might be in question because you can also import barrels from Europe or other places in the world.
Okay, so let me hop in there real quick. And, if you're listening, you may be going, okay, well, I can see what you're saying. Let's just kind of walk back through it. Historically, you want to be close to the sea. So the ships could come in, they could offload the product, and you could have your refinery. Now, with the shale revolution, you have stuff like in North Dakota, you have stuff in Texas, Oklahoma. You have all these places that are just kind of, random, for lack of a better term, across the U.S. And so having a refinery in Midland is more opportunistic now than it was maybe 20, 30 years ago. But one question that came to mind while you're bringing that up was, what about exports? So if you're going to be in the export business, still being close to the sea, would be an advantage. So how are companies overcoming that obstacle? So if you build a refinery in Midland, you still have to get it to the ocean. Are you saying that the cost is that much cheaper to ship it from Midland to the ocean once it's been refined that you can overcome that? Or is there something to look at and go, well, maybe we want to build it closer to the sea and just build a pipeline down there and do everything at the port?
Yeah, so that's a great question. So it's a combination of both. What's happening is that a lot of the marketing contracts, that, for example, before you had to import gasoline from other regions, let's say from the Gulf Coast, gasoline to ship it to the Midwest. Now those regions are more self-sufficient. So what's happening is that those refineries have displaced with higher throughput. They have displaced some of the imports from other states or other regions. So that's been one place. And you're right, absolutely right. The Gulf Coast refineries are still premium because they have access to advantage infrastructure systems that you're able to export final products. So I would say that the best refinery assets in the U.S. are those close to the Permian Basin and also the Gulf Coast. But some of the refineries, for example, in the East Coast, because you can easily import finished products from Europe, those are going to be at a disadvantage. So yeah, that's a great comment. So Permian-based linked refineries as well as those on the Gulf Coast because they have both advantages. They have easy export facilities, and also with a lot of the pipelines being built to take crude out of the Permian Basin, they're also getting that crude discount. But yeah, what I would say is that the shale revolution has made the Midwest or the refineries a lot more advantage than they were many years ago. The other advantage that, for example, a lot of the refineries in Illinois and kind of the Midwest area of the country is that a lot of the projects that were sanctioned many years ago for the Canadian heavy oil are coming online because those long-term projects, those barrels are flowing out into those refineries, and that provides also heavy crude oil advantage as well.
Okay, one final follow-up on this, and I want to move to what's happened since the shale revolution, and this will kind of lead into it. One of the things that you'll see, especially in the oil and gas, or I'm sure any major industry, is when you have such a rapid change, and the shale revolution was kind of an overnight, in a sense, change. Just all of a sudden, the natural gas price was skyrocketing, and now we've seen oil prices skyrocketing. All those things have come tumbling down since then. But what has happened? You mentioned long-term contracts, and as you know, there are sometimes in this business long-term contracts and long-term thinking. How much has this re-looking at refineries, repositioning our refineries, how much has that actually caught up to with what may be a good idea? So in other words, if you're saying, okay, well, it's a good idea now to put a refinery here, well, that to realize that, you may have realized that 2 or 3 years, and sometimes the permitting process for these things can be, 2, 3, 4 years to get it down the road. So have the refiners, how the downstream companies kind of realized where the best opportunities are and how they actually been able to capitalize on this, or are they still kind of going, okay, we still got to go through the permitting process, we got to get the plans out there. As you know, it can take years to get this stuff done.
Yeah, that's a great point. So there's been several ways that the downstream or companies with downstream exposure have been able to capitalize on the shale revolution. One of them, for example, I cited as the largest downstream company in the world, ExxonMobil. ExxonMobil, they haven't built any new greenfield refineries in the United States in their portfolio, but what they have been able to do is to expand their capacity for a lot of their Beaumont and other Gulf Coast refineries. So they've been able to debottleneck some of the refineries so they can process lighter crude oil, so they can take advantage of the lower cost of feedstocks in the United States overall. So they've been able to capitalize through doing that. The other thing they have going on for this would feed into the petrochemicals business. A lot of the Gulf Coast petrochemical companies are ethane based. A lot of the projects are in the past and currently So they have been able to take advantage of the low ethylene prices that have come about from the shale revolution and being able to produce lower cost, particular polyethylene, which is a base plastic used for many products downstream of that. So they've been able to take advantage of both from the crude perspective in the refineries as well as their integrated petrochemical assets in the Gulf Coast. So they have been able to capitalize on that. The other thing that's impacted companies in the refinery companies in the U.S. has been low cost of natural gas, not just from the byproducts that come out as a natural gas liquid, but also the refining of crude oil and petrochemical processing is very energy intensive. So by having low natural gas prices, you have low natural cost of electricity, as well as the natural gas that is being used for refinery for many processes, such as generating steam. I was looking at Valero's presentation from Valero from the last quarter, and they cited just a low natural gas price environment gives them a benefit every year in comparison to a European refinery, which has to pay energy prices tied more to crude oil. Gives them a benefit of about $700 to $800 million a year in EBITDA. So just by having a refinery in the United States, just from crude costs being the same, everything being the same, just to low energy prices, gives the refinery a large competitive advantage.
Okay, so let's kind of walk through this here now. If you're a producer in the U.S. and we have this shale revolution, one of the things I think you agree with me here, but tell me if I'm wrong, is it's kind of created almost the Amazon or the Walmart effect. And what I mean by that is, if you go to Amazon, they're always running a sale on something, and the hope is that okay, they can sell the book for maybe a little bit above markup, but not what Books A Million or whoever will mark it up, because they can also, Amazon hopes you buy a TV or diapers or whatever it is. Same thing with Walmart around Christmas time. They'll lower the cost of the toys, and they hope that you buy groceries or clothes or whatever the case may be. And so with the U.S. producers, I would imagine those who have a diverse portfolio, they're able to do that now. They can drill the product, they can build the pipe, and they can refine it all here in the U.S. And so they have the ability to where maybe production might not be a big margin for this quarter. The downstream side can make up the money.
Yeah, that's a great point. I was looking on Friday, both Chevron and ExxonMobil released second quarter earnings. And if you look at the United States portion, their U.S. Upstream assets actually lose money. They have, instead of earnings, they have losses every quarter for that portion of the business, but the downstream more than makes it up for it. So it's interesting to see, if you look at those companies, their dividends are based in the U.S., to U.S. And the U.S. stock market. So a lot of their dividend payments, I would say, have been a lot strengthened in a way because they have downstream assets. If they were just a pure play independent E&P companies, for example, like ConocoPhillips, they wouldn't be able to afford the level of dividends that they have, the large dividend yields that they have. They're able to do that in the United States because they have those downstream assets. And, a great example is ExxonMobil. They did a recent acquisition in the Permian Basin. They have pipelines coming out of, taking crude out of the Permian Basin into the Gulf Coast refineries. So they have an very, very tightly integrated value chains in the oil and gas business, from upstream, midstream, and downstream, and even on the export side and in the petrochemical side. So they can really sustain with their business model, sustain any kind of price environment for a long period of time that an independent E&P or independent downstream would not be able to do.
So what does that mean for the independent E&Ps? Because, you look at Exxon, okay, they're going to drill, they're not going to be overly aggressive just to be overly aggressive, but they can look at it and say, okay, well, we're going to make back our losses plus on the refinery side so we can absorb this much loss on the drilling side. Whereas these other companies, they're sitting back going, okay, well, I've got to drill to keep my acreage, or I've got to at least pay the interest on my credit line here. But how long can you have this limbo where you have some companies who are diverse like Exxon, who can make money on refineries, and they can lose money on the upstream, compete against a ConocoPhillips or something like that, where they can't do that? Their business plan just doesn't work like that. It would seem that eventually the Exxons of the world are going to push out these smaller companies just by the nature of their ability to make money when other companies can't.
Yeah, that's a great point, and you've seen it. It's been in the market recently with ExxonMobil. They're redeploying their treasury shares into buying some of the distressed properties from other companies. I think what's going to happen is that, and it will continue to happen, is producers have to be downstream. Used to be historically the margin business, but now the E&P has joined that on as well. So they're going to have to continue to be, as a lot of companies have been, some of the mid-sized independent E&Ps, on reducing costs and reshaping their portfolios to drill where their sweet spots are provide improve economics. But you're right, in this kind of limbo environment, some of the more expensive producers long term they might be some of those assets may transfer to more efficient producers. But yeah, definitely the E&P business has historically did not used to be like that. It was just a business of produce, build it, and they will come. Today, it's more of a how do you market your crude oil? What kind of contracts do you have? What kind of drilling efficiencies can you gain? So it's become a lot more similar to, interesting enough, to the downstream business where some of the margins on refining or marketing assets are very low.
Okay, so one final question. I'll let you get out of here today. What does this mean for the future? I think most people agree that we're looking at, I say stable. That's a very loose term, but prices that are going to be, 45 to 55. I don't see anybody that's really come out and gone bold enough to say, hey, we're going to be at $70 an oil, and here's where we're going to be at. It seems at 45. You may hear some folks at 60, but a lot of folks in the market right now are saying, hey, 50 is, if you can get to 50, you should be happy for a long time. So if we take back to everything we just kind of covered, the next 5 years, if prices stay 45 to 55, kind of that range, what do you expect to see to happen? Do you expect to see that E&P companies are looking to partner up with midstream and downstream companies and maybe, merge as a joint venture? Do you expect to see they're just going to try to, like you said, hit the sweet spots? Or do you think that they're going to go out of business and you'll see more of these bigger firms like Exxon go in and buy up acreage? We've seen some of that already. But the question for me is when will that bleeding stop, at least from the small producers? When will they stop going bankrupt and these bigger companies buy them out? And I'm not sure if we've actually hit that balance spot yet. What's your take on that?
Yeah, that is a great question. I would say a lot of it would have to depend on for some of the marginal producers on the credit markets, how when those credit lines resets and when they have to renegotiate new credit lines, how the creditors feel about some of these distressed companies, how they see their future, and also on the efficiencies and cost reductions that they gain. I would say for some of the, and it will be, I think a lot of it will be depending on the basin they operate. Some of the basins in the shale revolution may need a lot higher price to come back onto the market, but places like the Permian Basin, in my opinion, I think will continue to be a preferred basin because of the proximity to the Gulf Coast. The natural geological advantages that you can drill multiple zones from the same drill rig. So I think we'll be dependent. Some of the basins, like maybe back in North Dakota, may need a little bit higher price to come back. So I think it would just depend on some of the producers that are maybe possibly heavily focused on the Permian will do okay, and also companies with possibly international exposure will do relatively okay. For example, we're looking at Marathon Oil, the independent E&P, and they have a lot of assets in West Africa, done relatively well. Also companies like Chevron with assets in Kazakhstan. The Kazakhstan local currency has been devalued, so that has provided some relief in a sense to they reduced their operating costs in terms of dollars. So I see some of the companies may not have the best assets in the U.S., may look internationally.
Yeah, I love how you break it down there. There's so many things that are going on, so many angles to look at it, and it's really, it seems like it kind of depends on it for each analyst or each commentator or whatever you want to consider yourself. It kind of depends on which factors do you think are the most important. And everyone kind of has their own take on which factors you should look at, and that kind of will lend itself to where you think the market will shift. And I love how you broke that down there. There's so many moving parts in oil and gas and in energy in general that it's fun to kind of sit back and watch the pieces unfold and try to put the puzzle together. But sometimes it's a little bit harder than it sounds when you sit down and talk about it.
Yeah, and absolutely. And I would say on the this may be for I guess for a future podcast, I would say in the downstream space, what I would say is that a lot of the marginal refinery assets, such as if you think about it, like possibly the West Coast, California being a high cost state, and also some of the refineries in the East Coast. European refineries, the least complex refineries, the ones that are can only run on light crude oil. Those assets in the future, I would see them as being disadvantaged because of the low complexity of the refineries, and also competition from. We've even seen China's actually started exporting refined products into the market, so they become from a net importer product to a net exporter, slight net and the exporter of products. So in the international space, I would see a lot more challenges in the downstream space, in downstream oil and gas.
Absolutely. Well, Alfonso, we're going to let you get out of here. I want you to make sure that you plug everything. I know you've got a book and another book you're working on. But before we do that, just a couple things. One, we look forward to having you on as a monthly contributor to the podcast, so thank you for that. Also, as we mentioned earlier, you're going to be on globalenergymedia.com doing some written pieces. And there's one more surprise that we're going to leave until we get the details worked out. Hopefully, I can release that here in the next week or two for the listeners. Thank you for coming on. Plug and promote your book and anything else that you need to before you get off here today.
Yeah, thank you. Thank you very much for the opportunity. So about a month ago, I released my third book. It covers the petroleum refining and marketing industry of oil and gas industry. So it is a very interesting book. So I've taken a lot of the basis from my first book and I've expanded it tremendously. I've added a lot of chapters on financial analysis. So if somebody's interested in financial analysis, this is a great book to pick up. And I've also covered around 8. So it takes a deeper dive into refining, marketing, and trading of hydrocarbons. So you can get it on Amazon. It's oil and gas company analysis, petroleum refining, and marketing. And if you're interested, you can find more about me on Google my name, Alfonso Colombano, and it will be the first 2 links. So I'm very excited. Thank you for the opportunity for being on the podcast.
Absolutely. Well, listeners, we will link to all of that information in the show notes so you can find Alfonso. And then as soon as we have all the details worked out about where he will be on globalenergymedia.com, we will also put a post up about that. Alfonso, thank you for coming on. Look forward to talking to you soon.
Thank you very much.
Thanks again to Alfonso for coming on. Really enjoyed the discussion. And question of the day. What do you think about this trend? Will the larger E&P companies that have a downstream sector, like Exxon, will they be able to maneuver into a position that keeps smaller producers from being profitable? Because they can drill, they can do things that other E&P companies can't do, and then they can make money on the backside with the refineries. Love to hear your thoughts. Ryan at globalenergymedia.com. The Global Energy Leaders podcast is produced by Michael Sims and Chris Prine. Chris Prine also serves as editor for the Global Energy Leaders podcast. Until next time, keep climbing.
Thanks for listening to the Global Energy Leaders podcast, powered by R Squared Global.